It's all well and good to build a $2, $3, $4 million portfolio, but if you can't hold it, it doesn't matter.
And if you don't understand the numbers and you haven't run the statistics, then you don't actually know.
Jordan de Jong, property investor and founder of Gameplans, teaches us how to safeguard the growth of our portfolio to make sure we can keep growing.
Diversifying the portfolio. So this can be a couple of different things. If you had to sell one of those properties, you have to pay capital gains tax.
Speaking from the experience of analyzing literally thousands of people's portfolios, Jordan opens up some of the key insights to safeguard your portfolio.
I just want to make sure that I've got 6 months worth of savings. As we all know, the biggest cost or wealth killer is...
If you're wanting to take your portfolio growth to the next level, learning how to safeguard its growth is one of the most important skills you can learn. My name's Todd Sloan. This is the Pizza and Property Podcast, and you're listening to my chat with Gameplans founder, Jordan de Jong.
Jordan de Jong, how you going, man?
Good, mate. It's good to see your face again.
Mate, it's good to see yours. I got to say, the Gold Coast is doing its thing. Your look has completely changed from when you and I first met. I reckon you're rocking this, dude.
I love the hair, mate. It's all about the hair for me.
It looks cool.
Even though I can't technically surf, I still get out in the water.
Just sit on a board, claim the look.
Yeah. Paddle out and just look out.
Mate, today we're talking about buffering your bets, growing a portfolio safely. You've got a very unique perspective on this because you get to have a look at literally thousands of game plans through Gameplans, your software that you've created, and to be able to see the difference between someone going maybe a little bit too gung-ho and things could fall apart. It's all good when it goes well, but versus like maybe going a little bit too slow. There's that middle ground of growing a portfolio safely. 6 points to cover off. Before we get into it, is there anything you want to kind of set the stage with?
Yeah, 100%. I think there's two elements to it. So one is running through the numbers, as I love to do, and you know. But the other thing is the sinking feeling that you get every time you purchase a property as well. So for me, every time I've purchased a property, I have this feeling in my stomach as soon as the settlement period's done or the contract signed of like, have I done the right thing? Is this the right decision for me? What's going on? If you don't understand the numbers and you haven't run the statistics, then you don't actually know if you're going to be able to survive with this purchase.
Yeah, so it's more hoping rather than planning.
Exactly.
Yeah. All right. So for people that want to go, I'm already feeling what he's saying here. I want to go down the planning route. What's step number one?
Step number one is always having a safety buffer. So for me, what I like to do is just understand what my personal expenses are and what all of my portfolio expenses are. So I stack them all up together. As a household, I know roughly my numbers are about $12,700 a month after tax. And so for me, when I'm building a safety buffer, I go, okay, well, I can't sleep unless I've got 12 months worth of savings, because if the business falls over, or if I have to sell one of the assets, if something happens to mum or dad, I've got cash available that I've got access to that I can use for whatever happens. So for me, I just want to make sure that I've got 6 months worth of savings. If you take that 12 grand, times it by 12, it's like 140 grand, which is a lot. And not everyone has that much that they want to be comfortable with.
That's what I was just about to ask you. What, for anyone looking at it going, I'm not saving 140 grand, what would you say is a minimum that's still comfortable?
Some people are really happy month to month, but I'd say most people sort of sit between 3 to 6 months. And it depends what you do outside of that. You could have liquid assets as well that you've got access to that you could then utilize. But for me, having it in an offset account that's saving me 6.5% per annum still feels like a bit of an investment anyway.
Yeah, makes sense. All right, what's number two?
Number two is maintaining a healthy LVR. So one thing when you're starting to build your portfolio, what naturally happens is typically you can go for something like lender's mortgage insurance or do a guarantor loan, maybe using 5 or 10% deposit. And so you have this LVR as you start to go. And I think that's great if you can get into your first one and leverage that way. But what happens as we start to build the portfolio is we generally take equity from purchase number one and use that as a deposit for purchase number two.
But growing a bit more aggressively.
Exactly. But what you don't realize is, well, actually, if you analyze purchase number two individually, you can see, well, it's actually 100% LVR or 105% LVR because you've used all of your equity from this first one. So like looking at each individual property, what everything's going towards that and going, okay, is that too much? Am I like, if I have to sell that asset, am I going to have a worst case scenario? But then you do also look back on the portfolio and go, well, overall, we're at 80%. That's quite comfortable. But not what a lot of people think about is like if you had to sell one of those properties, you have to pay capital gains tax. And so what happens is a lot of people keep refinancing their portfolio back to this 80% LVR, but their first property's grown by 100 grand, 200 grand. And if they sold that, they'd have to pay capital gains tax. And so if you look at the portfolio holistically and you go, well, worst case scenario, rainy day situation, I had to sell everything. Am I going to be able to pay all of the debt back and all the capital gains tax and all of the selling costs that are together? So it's just about running those numbers and being like, worst case scenario, if we had to sell everything, are we going to be comfortable?
That's actually a really good exercise to do, whether you want to sell it or not, just to go, if I had to sell right now, what would I actually be left with? Love it. Okay. And the other thing that I'm really picking up from that is keep the cash savings going. because if you are going to keep going through like going 95% LVRs, and just for anyone that's a little bit newer, LVR loan to value ratio, you're going to be growing with more risk. So if you can keep the cash going into your deposits, it's just going to de-risk you more and more as you go along. Cool. All right, that's number 3.
Number 3 is just ensuring that you've always got surplus cash flow. And this is quite an obvious one, but it's really looking at that next purchase. So imagine at the moment you're saving around sort of $3,000 a month, you're looking to do another purchase, and you realize that this purchase is actually going to put you into a negatively geared position, which is quite common in a 6.5% interest rate environment. But let's say that you go from saving comfortably $3,000 a month down to $1,500 a month. At the $3,000 mark, that's enough for you maybe to do a $5,000 or $10,000 holiday every year. It's enough for you to go out for dinner every now and then and enjoy life, buy some nice Christmas presents for the kids, whatever it might be. When you come down to those smaller numbers at $1,000 or $1,500, it might make you a little bit uncomfortable, and you might go, actually, we can't afford to go on the family holiday this year. Actually, we can't go out for dinner when we do that. And even though you're still saving money, there's a big change that happens in the back of your head where you go, am I going to have a big lifestyle change if we don't have enough buffer in our cash flow that's going forward?
So if there's, okay, so I want to make sure I understood you right there. So you're talking about basically keeping the lifestyle the same, but making sure the cash buffers keep up with your lifestyle. Is that right?
Not necessarily your lifestyle, but if you're saving comfortably $3,000 a month before you do your next purchase, and then you do the next one, and all of a sudden now you're only able to save $1,500 because you're negatively geared, there's a mental switch that happens where you go, it was fine to go on a $10,000 holiday when we were saving $30,000 a year, but it might not be fine if we're only saving $15,000 a year. And so you kind of have this mental capacity of like, you don't want to, I'm a big fan of delaying gratification, 100%. And if that's the risk that you want to take, go for gold. But also, you want to enjoy it along the journey as well.
Yeah, there's no point eating beans on toast and becoming a billionaire. Like it's, Scrooge McDuck. All right, man, I like that. We're halfway through. Number 4.
Planning for the worst case scenario. So what I really love to do is factor in for examples of kind of what we've just gone through with the whole pre-COVID period where interest rates increase really dramatically. So what I do is take that 6.5% that we're at now and go, well, what happens if interest rates go to 8.5%? Am I able to maintain the portfolio? Am I negative position? And it really works off the back of the last point. If your cash flow goes to $1,500 and then at a 8.5% interest rate, your cash flow goes to negative $500 a month, it's like, well, everything kind of goes out the window. And even though you might have 0.1 of the cash buffers, might only get you through a 12-month period, 3-month period, or whatever it might be. And so, as we all know, the biggest cost or wealth killer is transacting on property that's 6% to buy and 3% to sell. So if you have to do a fire sale because you can't hold on to these properties anymore, you might be in a worse financial position than if you had bought the property in the first place. So if you actually sit down and go, okay, worst case scenario, property market drops by 10%, we don't have to sell, but interest rates now go up at 8.5%. We're in a very negative cash flow position. What are we going to do? If we had to sell a property, are we going to be at a loss? And so it's just about running all these scenarios and going, okay, worst case scenario, are we still going to be comfortable? Do we have to make a rush decision, or are we comfortable to keep doing this purchase moving forward?
Actually, an unstuck unstuck application. Actually, you were on an unstuck episode, and he sent in, and I called him, and I was like, "I'm sorry, but this doesn't qualify for an episode, but I'm going to put you in front of some serious debt solution help." Like, he grew the portfolio so fast. This is only the other week, but I've had a few similar kind of reach out, and it was just to the point of, he kept thinking he was doing the right thing by buying and buying and buying, but then everything got so negative, and it's not a good place to be in. And it really, realistically, it's a cash flow issue. If you had have got stronger yields and sort of hadn't leveraged quite as much, you'd probably be able to hold a lot more of them. So it's all well and good to build a $2, $3, $4 million portfolio, but if you can't hold it, it doesn't matter.
What's the point? You don't have to sell one.
Yeah, okay. So plan for the worst case scenario. And I love the idea of stress testing the portfolio. Second to last, number 5.
Diversifying the portfolio. So this can be a couple of different things. I mean, we obviously talk about different locations across Australia. A really good point of this is I had a client the other day who had 4 properties in the same suburb in Melbourne. And as we all know, Melbourne's underperformed over the last 2 to 3 years. And so he's got all these friends that are other property investors that have done really well. They've been able to extract equity and continue to build the portfolio, where he's just kind of stuck because he's got 4 assets in the same location that have underperformed. So he's kind of shooting himself in the foot. And that's a really good understanding of diversification in terms of locations across the country. You're open to different markets across the country. You take advantage of their market cycles. But it's not just the residential assets. You can also move into different types of assets, such as a commercial property or other types of investment vehicles. But at least having some sort of diversification across the portfolio, so that if you're in a market that doesn't perform, you still take advantage of different market cycles.
So diversification from estate base, asset base, basically just across the board, but still within the property space.
100%.
So you're not talking diversification, go buy managed funds sort of thing.
Yeah, 100%. I mean, you can if you want to keep diversifying that way, but within the portfolio as well, definitely.
Gotcha. All right. Lucky last.
So just doing those regular financial checks. I don't know about you, but I've got a monthly reoccurring meeting with myself, which is an hour. Well, actually me and my wife now. We sit down for an hour. We go through all of our financials. We go through all of our bank statements. We check if we're saving what we think that we should be saving. And if we're not, we go through all of our expenses. And if there's an expense that's, $1,000 or $2,000 more than it should be, we go, well, what was that? Is it a one-off fee? Is it something that we've done? Oh, we bought a car last month and have to make the car repayments. Now we've got to factor this into our savings. And so it's just setting time for yourself, because I've been through periods of my life where you kind of just forget about it and you kind of just go 6 months, 12 months and you go, everything's okay.
So easy to do.
Yeah, 100%. And so just setting those regular financial checks with yourself to go, am I on the trajectory that I thought I would be? If I'm not, what do we need to do to get back on that trajectory?
Can you open up a little bit about the check? Being a slice, we can't go into too much detail, but Bianca and I have only just started doing this probably 6 months ago, maybe 12 at a push. And I kind of felt silly that we hadn't been doing it sooner, because you're right. It's like find the little problems before they become big problems. And it just makes so much sense. But is there a little high level kind of checklist or something you can share?
Yeah, so the best thing that I do, and this, I've been through everything where I used to track every cent and dollar, literally allocate where it's going, how much it's contributing, wherever, had spreadsheets like crazy. But one really simple thing that I do now is every month I just compare how much did I have at the end of the month or on the first of the month in my bank account, and how much do I have now? And what's the difference between those two things? So if I've got $5,000 more that I did last month, then I know that I've saved $5,000. And then I can track that over a 6-month period. If you're doing it every single month and you go, okay, well, 3 months I saved $10,000 and then for 2 months I saved $3,000. It's like, well, I'm not saving at the rate that I should be. Now let's unpack that, dive deep into it and search where that money went so that we can track where we're going.
Okay, so you look sort of high level first, and then if a problem comes up that looks large enough, that's when you dive in deeper.
Dive into it. Yeah.
Jordan de Jong from Gameplans, thank you so much for jumping on the show, mate. I think this is going to help a lot of people as far as the checklist is concerned, grow their portfolios much safer.
Mate, it's always a pleasure. Thank you.